Hi, good morning. Hope all of you are doing well and good health. Today we are going to discuss in this video the benefits of trade. This is my second session for this video because the countries endowed with different assets and natural resources. Some countries may produce the same good more efficiently and therefore sell it more cheaply than other countries. Countries that trade can take advantage of the lower price available in other countries. This principle, commonly known as law of comparative advantage, is popularly attributed to English political economist and the name also David Ricardo and his book on the principle of political economy and taxation in 1870. However, it is likely that Ricardo's mentor James Mill origination the analysis $28.5 trillion, the total value of the global trading market, according to the United States. Number one, Ricardo famously showed how England, Portugal both benefits by specializing and trading according to their comparative advantage. In this case, Portugal was able to make wine at low cost while uh, Portugal making low cost while England was be able to manufacture cloth cheaply by focusing on their comparative advantages. Both countries could consume more goods through trade than they could in isolation. The theory of comparative advantage helps people to explain why protectionism is often counterproductive. While a country can use tariff and other trade barriers to benefit certain industries or interest groups, these policies also prevent their consumer from the benefit of cheaper goods from abroad. Eventually, that country would be at an economic disadvantage relative to countries that do trade. There are the number of the great benefits to covered call options. Strategy is the approach to trade allows you to create reliable income from our stock positions while reducing the amount of risk that traditional investors face. In addition to generating solid returns, there are some very attractive tax advantages available to covered or traders. We will get it into details shortly, but first, a quick review of how covered calls work. To generate income with covered calls, ideally we want to buy or already own a quickly stock that is fundamentally strong. It can be treating water or showing positive price action, but important thing is that we do not want to do this with stocks that are falling rapidly. Using income of offset losses is a dangerous propositions forever 100 shares. Lot of this stack when we sell once call contract, a call option gives to honor that right, but not the obligation to buy 200 shares of stock at the specific price with a defined time period. By selling these call contracts, we are giving some else right to buy 100 shares of stock from us at a specific price. We get paid to sell this right, which is how we generate income in the form of premium. Other expire on the expiration date, if our stock is trading above the designated price strike price, we must fulfill the obligations and sell our stock. But it is the stock is trading below the strike price, we get keep our stock. We also get to keep the payment we received our sellings option contracts. Now we are going to discuss that tax treatment or covered call options. A general rule, the payment or receipts from the options contract can classified as a reduction in the cost basis of the stock. This is important, especially it comes to taxes. For instance, you bought a stock of $100 and sold March dollar 150 calls against the positions of $50 share. Your net cost of your position is the $100. If stock remains below uh, $50 and calls expire, you should not have to pay tax on the $300 income per tax $3 if you that receive selling the call contracts instead. You now own share of the stock with the lower cost basis. Some traders continue to sell calls against their stock positions continuously create income in their portfolio while slowly reducing the cost basis of their stock. When the stock is eventually sold, the total amount of gains will be reported as taxable gains, but there is a definite advantage in different taxes liability until the positions reaches long-term gain status simply to the next tax reporting period. And one thing remember, short-term capital gains are taxed as ordinary income according to the financial income tax brackets. For many investors, this can represent a significant saving potential as much as 25% to 35% of potential tax liability depending on your tax bracket. This also makes a significant difference when you look at the long-term return, the rate of your taxable investment accountant is a very good. Thank you so much. Today our session is going to end. Hope stay safe and we will discuss to continue the benefits of trade in next session. Thank you so much. Have a good day. Bye-bye.